we have had a shock effect in the financial crisis, but we're just still doing the same product that caused the financial crisis. Some segment of the market are just not able to borrow because the central bank sees the risks, accepts the risk, has put mitigants in place like the loan to income cap. But unfortunately, that medicine is now also killing those the hopes of many people to actually be able to get on the housing market.
Can you basically just, in a nutshell, try to explain what happened, why there was a financial crisis, and how that changed the financial services sector, especially in the City of London, forever?
Yeah. So what happened was that it was obviously a good economic, in the beginning, at least a very good economic period. Inflation was controlled, interest rates were fine at around 5%. People were getting wealthier, active. It was after the crisis of the late 80s, early 90s. Everything was in recovery. And the economy was working well. That meant that people felt good. They wanted nice houses. It was a very competitive market generally, and people borrowed increasingly to buy assets, and particularly houses.
Yeah.
Now it's all about affordability. If you have £1,000 to spend every month, you have to make sure that you can meet your mortgage payments. So the bank started offering products that met that £1,000 threshold, but they kind of forgot that if anything happens, your £1,000 might be different. And
Sure.
Also, the banks started lending to people that said they could afford £1,000, but could they really? Is a bit the question. There wasn't a real check on that. So people just wanted to buy the house, and they then borrowed the money. Now, what happened at some point, and particularly also in the US, a lot of people borrowed and bought houses that pushed up house prices to an enormous number of multiples of income. And at some point, people started thinking, well, everybody on low incomes is owning, a house, and can they really afford it? When the doubt started coming into the system, the money dried up, the lending stopped, and when people couldn't roll over their mortgages, they started defaulting, and particularly in the US, the pressure built, and that completely stopped everywhere at some point. At which point, the banks couldn't fund themselves anymore because the market didn't know what the risk was in the banks, and that's when the governments had to step in and rescue the banks because of the risky lending that they've been doing. The banks got a guarantee system from the government so that they at least could access the markets and fund themselves. It was a scary market. Some banks went under, as we know. Most of them were rescued. The other thing that happened at that time was the central banks. They stepped in and supported, and they lowered interest rates to a very, very low level, almost unacceptably low level. If you're an economist, and I am, money should never be free, really. And it basically was. But that obviously helped everybody, because if you have a lot of debt, but it doesn't cost much, you will not default. So that really helped the market to recover, but it became artificial, and it stayed probably too low for too long because money was cheap forever until, was it 2 years ago, when interest rates started going up again.
Yeah.
And that's why we now have the challenges that we currently face, where people suddenly have all the shocks because people had a 2-year fixed or a 5-year fixed. They're now increasingly moving to a payment which is 2 or 3 times as much, and that creates a new risk in the system. So it all started with building up this leverage in the system that we then kind of could afford because interest rates were put on a very low level. But that at some point had to go up because inflation was going up. You had geopolitical issues. And now we're dealing with risks that are not from 10 years ago. They are from almost 20 years ago, basically, when it all started.
Yeah, absolutely. Very, very good description, Arjan. What I wanted to ask you about, Arjan, you've alluded to this a couple of times, that the UK model is different. The UK industry is different to especially the Danish model. But the Danish model is quite similar to there's lots of countries who do it, that link pensions and mortgages together and have long dated fixed rate mortgages. Why is the UK evolved in a different direction? What's the reason for that? Why is it an outlier?
Yeah, it's a good question, and it probably started before I was active in the market, so there's a little bit of guesswork in it. But I
It's
think
not your fault then.
no, it's not my fault. I think it's funny how certain choices in a country just make certain things go into a certain direction, and it's not just the UK; it's the entire Commonwealth. So you can see that the
Right.
market has grown in the Commonwealth countries in the same direction.
Sure. What about America? America is more similar to Denmark, yeah?
Correct, correct. And the American system was set up after the savings and loan crisis, and a
Right.
big crisis in the 30s, where the banks stopped lending on
Yeah.
mortgages, and the same as in the financial crisis. So what the government did, they set up an agency just to let the banks lend, and they would buy the mortgages from these banks so that they could just lend without having capital or liquidity issues.
Sure.
So that is similar. Almost got there by solving that crisis in this way, where in Denmark it was 1850, I think. I don't know the exact date, but it's when I think the British Navy actually was bombing Copenhagen apparently, and they needed afterwards a way to rebuild Copenhagen, and they dreamt up this system, and that's been working for like 200 years.
Oh, wow.
So there's a different trigger point for different countries. We never had a trigger point like that in the UK, so the banks just grew, and the building societies were obviously doing the first lending of mortgages on deposits. And we've never changed that model. We've never had to change the model, and the deposit taking institutions just kept lending, doing the mortgage lending. Building societies became banks when they converted, and they just grew bigger. They merged, and now we have a situation where you have 5-6 deposit taking institutions that basically are the biggest and control the market. The rest is following that. So there has never been a trigger to really change and rethink in a shock effect or in a real crisis how to stimulate the mortgage market.
Right. Okay. No, that's good. Thank you for that context. So I suppose this is part of your core message then, is that you are trying to change or trying to provide a different way of doing things in the UK market. Yeah.
Absolutely, because we've had a shock effect now, which was the financial crisis, but we haven't changed. So we're still doing the same thing as we did in the financial crisis. And we've spoken to Americans, and American people they think 30-year fixed, that's the mortgage, and I don't take any risk. We have had a shock effect in the financial crisis, but we're just still doing the same product that caused the financial crisis, as some of the Americans told me. And I think that's right. But we haven't adjusted to the new world. So that's why some segment of the market are just not able to borrow, because the central bank sees the risks, accepts the risk, has put mitigants in place like the loan to income cap. But unfortunately, that medicine is now also killing the hopes of many people to actually be able to get on the housing market. So it's creating systemic risks in itself. So we need a change. We need to change that so that we, in a controlled manner, can get these people own a home or stay in their home if you're 50, 60, because a lot of people are being forced to sell their house because they can't afford to refinance their mortgage, or there's no product to refinance them.
Yeah.
So
absolutely.
we really need a change.